Welcome to yet another session of Dhan Ki Baat. Today we'll be talking about, are debt funds really safe anymore? Let's first understand what are debt funds. So I'm referring to debt mutual funds, which are typically those schemes in which you invest to get a fixed, stable, non-volatile return. These returns can typically range from about 3 to 4% liquid funds to up to 8 or 9% in corporate bond funds. Predominantly, these funds were considered to be relatively safe. But in the last 10 years, something very, very drastic has happened, which is what gave me the idea to make this video in the first place. So, what am I really talking about? I'm actually making a statement telling you that investing in debt is not safe anymore. In fact, the safety of investing in debt has consistently come down in the last 10 years. And I believe that will be a major challenge until the economy completely revives. So, when you invest in a debt fund or a debt mutual fund, you are actually giving the money to a mutual fund who then allocates this money into different companies, rather, gives this money to different companies investing in their bond paper, their commercial papers, investing in other FDs or cash equivalents, similar type of different debt instruments, further diversifying your investment. So rather than investing your money or giving your money on loan to one person or investing in one company's investment or bond paper, it is better to invest in debt funds. This is the rationale or psychology that people had who were investing into debt. There's nothing wrong in that. It makes absolute fundamental sense. However, it has been seen that the last 10 years has come out really, really bad for most of the debt investors. Because if I was to tell you, at this current stage, this juncture, I feel that investing into equity funds is much more safer than debt funds. Because investing into equity based funds, especially here I'm referring to index based funds, it is absolutely safe if, as long as you have a holding power, that you want to hold this fund for more than 5 years, 10 years per se. Anyways, the debt investing funds, the people who invest in debt funds are anyways thinking 3 years. If you just increase your horizon from 3 to 5 or 10 years, you're able to ensure that you always end up making money, come what may kind of scenario, rather than what can happen in a debt fund. So, what has really happened in a debt fund is what I want to tell you now. Do you know in 2010, JP Morgan, the debt fund that they had, actually lost more than 103 crore. So, if I was to, as I'm reading this article, I see that it wasn't JP Morgan, it was Aditya Birla money. 103 crores was lost in the options maxima strategy. Now, you can understand this might have been a one off case, but the same thing happened again in 2015. JP Morgan's fund had actually tumbled down on a money that they had given to Amtech Auto. 800 crores was defaulted on that particular fund. Wouldn't that be interesting to note that this is not the end of it? 2020, 2020, two funds came down. Which ones? One we all know, it was Franklin India. Yes, Franklin India Templeton had six of its funds shutting down, one of the biggest ones that we've actually seen happening. And they are still into dispute and recovery as we speak. It's not just that Bank of India's AXA Credit Fund also had slumped 50% overnight in April 2020. What is that telling us? That this state of the economic affair that we're living in, the state of the economy, is not rock solid. We are going through a very, very rough patch in the economic scenario as we live in today. And more of this is likely going to happen in the next 2 to 3 years. So, investing in a debt fund has given really, really bad taste, really, really bad experience to a lot of investors in the past. And I believe that experience is only going to increase. On the contrary, I believe the index based equity funds are going to do phenomenally well post a small correction that is likely, I believe, is going to happen in the market. One should always look into entering into those index funds rather than investing into debt funds. One should be looking at betting directly on the indexes, on the growth of the country, rather than certain companies who might or might not do well. And if they do not do well, you are in for a definite loss there. Because think about it, when you invest in an index fund, all you're doing is hoping for its recovery, which eventually happens. That's how the Sensex has moved from 100 points to 50,000 points. On the contrary, when you invest in a debt fund, you're just hoping the company in which you've invested will continue to pay you the interest. That is how you're making money. But the moment this company defaults, your money is gone. That is how money is being lost, and you cannot wait for this anymore. It's gone means it's gone. That is what the real problem is, that of a debt fund. So one should always look into investing into, for long term, always investing into equity funds. Now, what do you do for short term? You still want to invest, you also want to have a tax benefit. How do you invest for a short term in debt funds? I'm not saying completely eradicate debt funds from your investments, but for longer term, it is better to go for equity, and also not go into any other form of debt apart from AAA rated public debt, especially in times like these. What are those options? There's so many other companies which are government backed, which are known as quasi. You can invest in those. There is Power Finance Corporation, Indian Railways Financial Corporation, National Highway Authority of India, Rural Electrification Board, and so many other companies who are backed by the government's own entities, who have their own non-convertible debentures. One can really invest into those. There are other options where you can invest in certain funds which only have government-based entities. That's also a great option to do so. All of that is much better off than investing into other type of debt mutual funds. So it is better to invest directly in these, either through the direct route or using your own demat, rather than going for mutual funds, active or full-fledged mutual funds or different debt instruments. That is something one should really avoid, because this time debt is the most you can say asset which is under most pressure. I see that a lot more defaults are likely going to come, a lot more pressure is going to come, and with that pressure, more defaults are going to come, and the government is going to face even more pressure to try to bail them out. We've already been seeing that last 12 months, 6 banks have defaulted. Now the banks default when the companies default on them. Can you see the ripple effect of that? And that is exactly what is going to happen in the economy in the next 2 to 3 years. So this video is only intended to make you aware, to warn you, to move out of your debt funds, go into long-term equity-based investments or short-term government-based debt, to ensure that the safety of your capital is important. Because in a time like this, it is the return of your capital can be more important than the return on your capital. So I hope you enjoyed this very short session of Dhan Ki Baat. I really hope you're going to take some takeaways and take action accordingly. If you're someone who's already invested into debt, you know exactly what to do. If you're someone who does not, has never invested, don't know what I'm talking about so far, get in touch with us. Let us help you to get started on your financial freedom journey. And most importantly, if you're ever in doubt, don't forget to ask the wise guy.